Thank you for that introduction, and good afternoon, everyone. Sorry to have arrived just in time, but Mr. Modi's visit was apparently much more important than my visit here, and that obstructed my ability to get here, but somehow I managed to navigate the tube system to get here just in time. So unfortunately, I missed most of what Mr. Gauck said, except the end where he said some very good things about BEPS and how it will all be good for the UK. So I guess maybe that was all I needed to hear. I have a few slides here. I'm going to start off by maybe just talking about the origins of BEPS. Many of you will know that as a result of the financial crisis in 2008, that was really for the first time that you had world leaders get excited and start talking about tax. And they first started focusing on the issue of tax evasion and ending bank secrecy. And we have now come to a situation where today we not only have 129 jurisdictions, including many that some of you will refer to as tax havens, having agreed to implement exchange of financial information on request, but more recently, they have moved to exchanging this information on an automatic basis in order to counter tax fraud and evasion. The next phase of this focus on dealing with tax issues following the financial crisis was really to focus on the issue of multinationals and this issue that we call BEPS. And here you have what I think is an easy to understand definition of what BEPS is. And I should highlight that while many talk about BEPS in very sweeping terms, that this covers all of international taxation, it does not. What we were really trying to do was focus on a particular and important issue, and that was base erosion and profit shifting that could occur and does occur under the existing international tax rules because it is possible to artificially separate the location where real economic activities occur and where profits are allocated. This is possible due to tax planning strategies that exploit the mismatches and gaps in the current international legal system. And this enables the shifting of profits to places where there is no tax and the putting of expenses in higher tax jurisdictions. And for those of you who are more interested in pictures, well, this tells you basically what BEPS is about, where you have real economic activity, say research and development, sales or manufacturing in one country, and then you have the profits located in another country which happens to have no or low tax. In terms of how this can happen, well, here you have a diagram that describes it, and basically there are four basic elements to this type of tax planning. And basically, it won't surprise, I guess, most of you that one of the key elements is to ensure that you minimize tax in the market or production country, which will usually be a normal tax country. I don't want to say high tax versus low tax because we're talking about countries that have normal, not just high tax rates. The other thing that they will do, and they will do this, I guess, by trying to avoid having a taxable presence or by minimizing the assets and risks that they have there so that they don't get taxed, and to maximize the deductions, again, to achieve the same purpose. The other thing that they will do is to ensure that you have low or no withholding taxes. And then, obviously, to ensure that where the profits are received is a place where there are very low taxes, and this can be achieved either through the use of preferential regimes, hybrid mismatches, or through base eroding payments. And then finally, in the ultimate residence country of the parent, again, because if you assume a sort of normal rate of taxation, there what you will try to do is to minimize having assets and risks there because those attract taxation, and you will try to maximize the deductions. And so that is the scenario. Probably there are many more complicated scenarios than that, but that's a simplified version of the way that tax bases can get shifted out of countries. And so that was really the issue that we were trying to tackle. Now, most of these tax planning regimes are, in fact, legal. And that is the issue we were trying to address. Countries got together and said, we don't like the outcomes of how the current rules actually produce taxation, or don't produce taxation, I guess is the better way to describe it. And so they came together and said, let's work on this together to try and redefine the rules, to change them so that they do produce the outcomes that we want, and also to take into account the changing business models, the changing economy, the increased digital economy, an economy where intangibles produce so much value in today's business environment. The other thing that they wanted to do was to address the issue of fairness, because, and I know here in the UK probably more than anywhere else in the world, you have had on the front pages of the newspapers this whole issue about fairness, not only with respect to high net worth individuals hiding their money offshore, but also with respect to the fact that very large multinationals were legally paying very little or no tax here in the UK or anywhere else. And so it was important to address the issue, not only to create a fairer tax system, but also to address this perception of the lack of fairness. The other thing that we wanted to do was to ensure that we maintain the international mechanism for developing consensus here, because the international tax rules that have been developed have largely been based on a consensual framework agreed by governments. And the risk that we had at that point in time when we started this project is that countries would take unilateral actions, which would result in double taxation, multiple taxation, and a lack of coherence in the overall international tax system, which would not be good for governments, and it wouldn't be good for business either. And so that was really the main reason that we were trying to address this. And keep in mind, there were also the issues of the economic distortions that could occur when companies were more focused on after-tax profits than before-tax profits. So that was basically the rationale for the project. If we move now to the features, and I'll just leave this here for you to read very quickly. It has been a very fast-paced project. We have tried to make it as inclusive as possible. This was mentioned earlier about the need to include developing countries, and we have tried to include them and will continue with that effort to expand the inclusive nature of this work as we go forward. It's also been probably one of the most transparent and consultative processes that the OECD has engaged in, and you could see we published a lot of discussion drafts, over 12,000 comments received. Not all of them complimentary, but still, we appreciated all of that input to help shape this project. And then we had numerous consultations in the course of this, as well as used webcasts to reach an even wider audience. So now if we go to the BEPS package itself, and let me just recap very briefly what the history was in terms of the actual work we undertook here. We first, in February of 2013, published a diagnostic report looking at the root causes of BEPS. We then, in July 2013, published a 15-point action plan, and in October, just last month, we released the outcomes of our work to flesh out the actions that were mentioned in the action plan. And so these can be categorized in these three main pillars, but of course there is a lot of connection across these pillars. And I'll just run through very briefly some of the things that we have achieved in this project. In terms of coherence, which is where what we were trying to do is to bridge the gaps between differences in different countries' tax laws. And here we produced a report. Actually, we produced the first report on hybrid mismatch arrangements last year, and we finalized that report in October. But basically, This is one of the classic examples of situations where, through tax planning, income can essentially disappear, either through situations where, for example, a payment is treated as an interest payment, and so it's deductible, and that same payment in the recipient country is treated as a tax-free dividend. So you have a deduction, no income inclusion, and that produces a double benefit. There are also situations where you can have multiple deductions in different countries for the same payment. And so what we tried to do here is to neutralize the benefit of that sort of structuring by creating linking rules between different countries' tax laws. And we have a primary rule and a secondary rule, so that even if a country doesn't implement the standards that we have established here, you still can neutralize the benefit. Now, this doesn't mean that what we have said is that hybrid instruments or arrangements are bad for other purposes. What we've just tried to do is to neutralize the tax benefit. This should, we hope, drive taxpayers to less complicated, more transparent cross-border investments. In the area of interest deductibility, what we've tried to do here is to have greater coordination among countries in terms of how they limit interest deductibility, because, of course, this can also be a competitiveness issue, and no country or a country may have difficulty in limiting interest if its neighbor doesn't. And so what we've done is set out a corridor of interest limitations, basically based on a percentage of EBITDA. This is an area where it's really, I think, quite innovative in terms of the OECD's work, because we haven't really tried that sort of coordination of domestic tax policy before. The other thing that is an option here is that this can be supplemented by a worldwide group ratio, but there's more work, I think, to be done on that. But at least we have countries agreed that this is a common approach that they are interested in following. On CFC rules, we all know that those can really be helpful, especially to headquarter companies, to try and reduce the incentives to strip income out of other countries. And we have produced the essential building blocks for effective CFC rules there. And then on harmful tax practices, many of you may know that in 1998 we launched a project on this to focus on harmful preferential regimes. What we have done is updated that work to focus on substance, something that Mr. Gauck referred to earlier, and try to link the benefits of regimes to actual substance. And this was particularly the case in IP regimes. As you know, there are many patent boxes or knowledge boxes or whatever they're being called being developed in different countries. And what our report says, it doesn't say that those boxes are good, but what it says is if you're going to use that type of preferential regime, then the beneficiary will only get the benefit associated with substantive activities, and the proxy for that substantive activity is looking at the amount of R&D expenditure. And so that is what we've done there. The other important thing that we've done in this area is that we have now called for what is referred to as mandatory spontaneous exchange of rulings that affect other countries. A simpler way is probably to describe it as automatic exchange, but this will enable countries to be alerted sooner about preferential treatment that may be offered by other countries, and it will also, I suspect, have a deterrent effect on other countries from providing lowering of tax rates through those rulings. So that is also quite an important feature of the work that we've done. Now, on substance, the two key areas that the OECD has traditionally worked on are tax treaties and transfer pricing. And I won't be able to go through in the short time that I have everything that we've done in this area. But I think the key things here are we have agreement among countries to implement measures in their tax treaties to limit treaty abuse so that tax treaties serve their intended purpose of eliminating double taxation, but are not part of rather complex schemes to produce double non-taxation. And so that will be quite important in terms of a development. In terms of the permanent establishment definition, we know that part of the challenge that countries face was the way that companies were able to, under the existing rules, to circumvent the principles behind the PE rules. And so we have revised the definition of permanent establishment so that now commissionaire arrangements will no longer be possible, and you won't be able to circumvent the PE rules through fragmentation. So these are some of the important issues that we've addressed there. Now, in transfer pricing, we've done an awful lot to link the transfer pricing rules much more closely with substantive activities. And here we've made important changes to the fundamentals of the transfer pricing analysis of the arm's length principle, focusing on what the parties actually contribute in a transaction and including the risks that they control. Now, this doesn't mean that we are ignoring contracts. We always start from the contractual arrangements, but you need to look at what the parties actually did and whether their behavior was consistent with the contractual arrangements. We have also provided guidance on intangibles, building on these fundamental principles that eliminate the notion of a residual return for mere legal ownership, and that's a quite important change to the rules. We've also indicated that legal ownership alone doesn't result in an entitlement to profits automatically. And finally, well, it's not really finally, but one of the other key points, because really we've done so much in this area, is that the provision of funding alone will receive no more than a risk-free financial return. Now, on hard-to-value intangibles, this was one of the trickiest areas for us. We have provided measures that act as a backstop to possible abuses that are due to the information asymmetry between the information the taxpayers have and what the tax administrations have. And what we have essentially done, we have allowed tax administrations to assume that there would be a price adjustment mechanism, and so they can actually look at the results at the end of the day in certain circumstances. Moving very quickly to transparency, because I know we're running out of time here, but one of the key features of the work that we have done is we've looked at the economics of BEPS, and we have produced an analysis that is imperfect, we acknowledge, because the information is imperfect, but we estimate that 100 to 240 billion euros annually is lost globally as a result of BEPS. But more important than that figure is really the fact that we have identified what we need to do going forward in terms of the information we need in order to assess BEPS and whether the BEPS measures that we have developed actually have an impact in terms of changing the behavior that governments intended to change. So that is really quite important. We have also provided guidance on mandatory disclosure rules to enable countries that are interested in implementing these rules to learn from the best practices in other countries. One of the biggest, I think, one of the biggest changes that we have made is in the transfer pricing documentation area, in that for the first time, tax administrations will have a global picture of the operations of a multinational enterprise as a result of the country-by-country reporting, the master file, and then they'll also get standardized information through the local file requirements. An important part of this project is on dispute resolution. Here, now, this was not a BEPS problem for governments, but we recognize that with major changes in the rules, there would be a potential for an increase in disputes, and we needed to make sure that disputes could be addressed effectively and quickly. And so we have now established a MAP forum where there will be peer review against minimum standards in this area. Now, I know a lot of business people wanted to see mandatory binding arbitration for all countries. We didn't get agreement on that, but 20 countries are planning to move ahead in that direction. But if you think about why business wants mandatory binding arbitration, it's because they want certainty. And the certainty provided by arbitration is not only in the arbitration process itself, but by the fact that in those types of provisions, if after 2 years the competent authorities can't agree, then it goes to arbitration. That acts as an incentive to the competent authorities to finalize and reach agreement. And so we've built in this similar time frame into these standards that we have put out in this area. Now, on the digital economy, what we have done is an analysis of the digital economy. This report we produced last year and finalized this year, but basically what we have said is the digital economy is the economy itself. The other thing very quickly is we have proposed and are now in the process of developing a multilateral instrument that would enable the modification of the wide network of bilateral tax treaties that is out there. And there are over 3,600 bilateral tax treaties, so if we are able to use this mechanism, it will be quite useful in implementing the BEPS measures very quickly, because the alternative is going back and renegotiating all of those treaties, which could take decades. Now, in terms of what's next, it was already mentioned that there is a technical follow-up work that needs to be done. We have a list of issues. I'm sure others will bubble up as we move ahead with implementation. We are going to develop an inclusive mechanism for implementation and monitoring. This is key, and I really think that the big work lies ahead, and we are preparing ourselves to do that. Beyond BEPS, I put that there just as a marker because this work, as I said, has been very much focused on dealing with problems with the way the current rules operate. And so moving beyond that and beyond the implementation and monitoring, which is, of course, a big chunk of work, we also need to look at things like tax and growth. We have a project that we're working on that and looking at how tax can be used to foster innovation, investment, and trade. That's really critical as part of the OECD's work because, as you all know, the economy, the global economy, is still not where it should be. Anyway, that's it. Sorry if I took a little too long. Thank you.